Hey there! Welcome back to Legend Finance, the channel where money talks and we listen. Today, we're diving into a topic that's hot on everyone's lips. You guessed it, rising interest rates. Now you might be thinking, that sounds a little gloomy. But don't worry, we're here to shine a light on the positives and show you how to navigate these financial waters with ease. Yes, rising interest rates might mean your mortgage payments could increase, but hey, it's not all doom and gloom. This is also a sign of a robust economy, of growth, and of new opportunities. We're here to arm you with the knowledge, the strategies, and the confidence to turn this tide in your favor. From understanding the dynamics of the market to providing tips on how to manage or even benefit from these changes, we're going to cover it all right here, right now. So buckle up, get ready to learn, and let's make this rising tide lift all our boats. Stay tuned to Legend Finance, where we make finance fun and understandable. Let's get started. Regardless of worldwide events, one topic remains perpetually hot: real estate. The current allure of home buying, particularly due to the remarkably low interest rates, is undeniable. At Legend Finance, while we're not directly involved in selling homes, we are certainly well informed about the subject. Over the years, we've observed interest rates fluctuating and have assisted many clients in navigating their implications. Yet, have we ever delved deeply into the true benefits of a lower interest rate? Now is the time to unravel the substantial advantages this can offer prospective home buyers. You know, when we talk about low interest rates, they kind of seem attractive, right? You see numbers like 3%, 4%, and even 5%. It might feel like pocket change, the kind your grandma used to give you to buy a sweet treat from the local ice cream parlor, at least in our neck of the woods. But let's put the joking aside for a moment, because we're here to really unpack the genuine benefits of these seemingly small percentages. It might sound like a complicated topic, but we're going to simplify it. We'll whittle it down to the real impact on not just your monthly payments, but also the total cost over the life of your loan. So let's get started. Example, let's continue using $300,000 as our loan amount, as it is a nice and easy figure. Suppose you buy a house worth $320,000 and make a $20,000 down payment. That means your loan amount is $300,000, which could be more or less depending on various factors, such as your location and the home price. What does the 4% interest rate mean for your monthly payment and overall loan? To understand this, it's crucial to note that the 4% interest rate is an annual rate, and home loans use compound interest. That means the interest is calculated on the outstanding principal each month, not on the original loan amount for each payment. To calculate your monthly loan payment, you'll need your loan amount, your monthly interest rate, and the total number of payments. Multiply your loan amount by your monthly interest rate to determine the number of payments. Then divide that by the difference between your rate plus 1 and the number of payments minus 1. This gives you the monthly payment. In an actual example, for a $100,000 loan at a 5% annual rate for 30 years, you convert the rate to a monthly rate of 0.00417. Multiply the loan amount by this rate to the power of 360. Then divide by 1 plus the rate to the power of 360 minus 1. The result is your monthly payment, where P is the principal loan amount, R is the monthly interest rate, annual interest rate divided by 12, N is the number of months, years of loans x 12. Let's break down how we calculate our monthly mortgage payment. We have an annual interest rate of 4%, which we divide by 12 to get a monthly rate of 0.00333. Then we figure out that we'll be making 360 payments over a 30-year period. To find our monthly payment, we use this formula. Think about how we calculate our monthly mortgage payment on a $300,000 loan. Let's use an easy-to-follow fraction. For the top part or the numerator, take 0.00333 and multiply it by the sum of 1 and 0.00333. Then raise the whole thing to the power of 360. For the bottom part or the denominator, raise the sum of 1 and 0.00333 to the power of 360, then subtract 1. Now let the calculator do its job, and voila! Our monthly payment turns out to be around $1,432.25. This payment includes the principal and interest. Here's the fun part. In the beginning, the majority of your payment, about $1,000 in the first month, will cover interest. But don't worry, each month you'll pay a little less interest and a little more towards the principal. starting at roughly $432.25 from the first payment. This is the thrilling journey of repaying a mortgage. How A2 works. Now here's where things get a little interesting. So you just shelled out $1,000 for the first month's interest. But hold on, there's also a chunk of your payment that goes towards the principal. That's the original loan amount, in this case, that $300,000 we talked about. So let's say $432 is going towards the principal. So you've got $1,000 in interest and then $432 chipping away at the principal. Your loan balance drops by that $432 amount, bringing it to a new total of $299,568 for the next month. What happens next? Well, they take this new balance, calculate your annual interest again, and then divide by 12. They end up with a new monthly interest amount. It hasn't changed a lot, but it's starting to creep lower every month. Here's the really fascinating part, folks. No matter how you slice it, the interest and the principal amount from that very first payment will always add up to the same total, even though your interest is gradually dropping and your principal amount is slowly rising. It's kind of like a seesaw, balancing out every time. Even 30 years down the line, your last payment might be a tiny $5 for interest and a whopping $1,427 going straight to the principal. Every month, every year, it's always going to tally up to the same amount. Why exactly that amount? Well, we're not sure. We'll leave that to the brainiacs. But for now that we've laid out the basics, let's take this concept and apply it to 3 different scenarios. Alright, let's stick with our $300,000 loan amount for simplicity's sake. But this time, we're going to shake things up a bit and look at how things change when you're dealing with different interest rates. We're talking about 3 scenarios here, one with a 3% interest rate, another with a 4% rate, and the last one at 5%. Now here's a constant in each of these scenarios. You're always going to end up paying back that original $300,000 you borrowed. That part doesn't change because, well, you borrowed $300,000. But here's the kicker. You know that one extra percentage point of interest you were eyeing. At 5% interest, once you've lived in that house for 30 years, you've paid a whopping $279,767 in interest alone. So you're not just paying back that $300,000 you borrowed. Your total payment rockets up to $579,767. Hold on a second, we were talking about 5% interest, not 50%. Well, we were just as curious as you, so we played with the numbers a bit, and we found ourselves wondering what interest rate would make us pay double the amount we borrowed. So what would it look like if our interest was essentially 50-50? Well, we crunched the numbers and found out that 5 times the interest would make us shell out $300,000 in interest alone. Yep, you heard that right. We're talking $600,000 total, a hair's breadth from doubling that initial loan. Remember, we're just dealing with 5% here, and we're already close to paying double. So that monthly payment, it comes out to about $1,610.46. And keep in mind it's just the principal and interest. We haven't even factored in other costs like taxes, insurance, and all those other fun expenses. Okay, now let's shift gears and take a look at a 4% interest rate. Here's what we discovered. Your monthly payment drops to $1,432. Not too shabby, right? You're saving almost $180 every month, nearly $200, which seems pretty reasonable. And finally, let's tackle the 3% scenario. What we see here is that the monthly payment takes another dip, this time down to $1,264.81, and the total amount of interest you're paying. That drops to $155,332. You're shaving around $60,000 off your total interest paid and saving just under $200 on your monthly payment. Now brace yourself for the big reveal. When you compare the 3% and 5% scenarios, we're looking at a difference of about $120,000 over the life of the loan. That's an eye-popping amount you could have been handing over to the lender just because of those 2 percentage points in your interest rate. So what's the big picture here, folks? This especially matters when you're thinking about things like down payment assistance. But we often see our interest rates that are 1, maybe even 2 points higher. Now we get it. We're mostly a bunch of young folks here who aren't too keen on thinking about what's going to happen 30 years down the line, or you might even be considering selling your house before then. But humor me for a second. Imagine that you stick around for the full 30 years. Do you think having an extra $120,000 in your bank account would make a difference? That's the kind of change most of us would love to see. What we can say for sure is this: if your interest rate is higher, you're going to end up paying a whole lot more over those 30 years. Now, here's a bit more food for thought. Just 1 point of interest could mean you're shelling out, on average, an additional $60,000 over the life of the loan. That's no chump change, right? And don't forget about your monthly payments. They could go down by around $200 to $300, depending on your specific situation. But in the examples we've been working with, you're looking at shaving off almost $200 every single month. How much of your payment is dedicated to interest? We've been exploring how interest rates affect your mortgage payments, using a $300,000 loan as an example. We found that a small change in your interest rate can make a big difference. At 5% interest, you'd be paying a total of around $579,767 over the life of the loan, almost double the amount you borrowed. However, when we reduce the interest rate to 4%, we notice savings of almost $180 every month and $64,000 over the loan's lifetime. And if you were lucky enough to secure a 3% interest rate, your monthly payments would be around $1,264.81, saving nearly $200 a month, and you'd also be shaving off around $120,000 over the loan's lifetime compared to the 5% scenario. What was really eye-opening, though, was the ratio of your payments that go towards interest. With the 5% rate, 77% of your payments in the first year are going towards interest, meaning only a small portion is chipping away at the actual loan. We found that this ratio could shift significantly with a lower interest rate, saving you even more money in the long run. Enjoyed the information? Don't forget to like, subscribe, and ring that bell for more financial wisdom. This is Legend Finance, signing off. Keep saving, friends.